Welcome back to Investing Wizards. I have the pleasure of having Chris Seifel, who is running his own money, has an interesting background. We'll get into that. So welcome to the show, Chris.
Thanks, Rob. It's great to be here. I love Koyfin, love what you guys have done with the website. It's highly valuable to me and my process, so I'm very excited.
Oh, do go on. Keep going. Don't stop. That's awesome. Thanks for that plug. We could go over some of the new functionality, which we just released as we're talking about the product, or your investment ideas. But would love to give people of you a sense of, what's your background? How do you invest? What's your investment style? Kind of a quick background.
Sure. So I can start back in college. I was going to play baseball at the University of Miami, but I had 3 elbow surgeries. So that plan was nixed. So I happened to just get an internship and was introduced to the stock market and fell in love. And from there, I knew that my pathway, my career, it belonged to the public markets. So fast forward about 4 years, I did some banking jobs and then went to a family office, private equity style, where we bought and operated seniors housing facilities. So everything from independent living to seniors to skilled nursing facilities. And I was very fortunate there to get the most rigorous analytical framework that I could imagine. We built operating models that were 17,000 lines long, where we were modeling everything down to the individual components of the Medicare rate. So I really developed this background in how to do fundamental bottom-up and top-down analysis, which is really the framework that I take to the public markets. So fast forward another about 3 or 4 years, I got a great experience. I accelerated up a track at that company, and I decided that I wanted to start my own track in the public markets. So in April of this year, I left the private space. And in June, I started just getting more involved on Twitter, sharing some basic ideas. I was kind of told to, and I was told to a great idea by a good friend, Seifel Bloom, who I think most of your listeners might know. And, I just started posting some ideas about some companies that I was following and that I found interesting. And all of a sudden, I just started kind of blowing up. So, from June to now, I've grown from none to 18,000 followers. And, along those same lines, I was encouraged to start a newsletter to kind of dive deeper into the companies. Because listen, a thread, 10-tweet thread, you can only get so deep, right? It's going to be very superficial. So I started this newsletter, and back in August, my first company I did was CrowdStrike, which is actually kind of what I want to talk to you about. And they just reported great earnings again, last night. And from there, my newsletter subscribers have really grown fast as well. I'm at 4,300 or 4,500 subscribers now too. So it's been quite an amazing experience, and if we want to talk about my investment, framework and process, however you want to define it, I think that I always think in first principles, right? What is the most basic fundamental level of a theme or a company, whatever it may be. And for those that have read my newsletters, they'll see that I also take an Occam's razor type of approach to companies. So I only focus on the 1 to 2 critical factors, maybe up to 4 that really drive a stock. And so why is that, right? If you have more than that, and similar to like an AI program, I've been diving more into AI recently, so I'm going to make that correlation. If you have too many layers in a neural network, it's hard to understand where the model went wrong. And I think it's the same thing with investing. If you have a thesis that's based on all of these certain things going right, well, how do you know which one kind of derailed your investment thesis and why the thesis went wrong, right? So I focus on 1 to 4 critical things, and those 4 critical factors are a result of talking to people in the industry, digging through the filings, kind of going through the process itself, and the end result of that are the critical factors. So that's kind of where I start. And what's key for me is a written, detailed checklist that I follow. So I think that a repeatable, scalable process is something a lot of investors might not do, but for me, it's highly useful because I know what works and what doesn't work. And I know that if I'm missing something, it's because I didn't follow my process. So I always stick to my process. And I think the high level framework I take is something that was popularized, created by William O'Neill, called the CAN-SLIM methodology. So, very high level, you're focusing on high current annual sales and EPS growth. You want trending, 3 to 5 years of high EPS growth as well. And these are all things that, based off of his experience, analysis, and 60 years of an empirical process, has shown that these are what the market leaders have shown before their big runs. And then things like, new product, new management, and the new all-time highs. There's a focus on supply and demand. So how much of a float is out there? You don't want to have too big of a float where, you can't really move a stock, but at the same time, you can't have a small float where institutions wouldn't be interested in even buying it because they would just be moving the stock themselves. You want to have the leaders, not the laggards in industry. For the most part, they're the stocks that really perform well. You'll see that 50% of that is really comprised of how their main industry or sector group does itself. So you want to be in the leading industries, and then within that, you want to be in the winning stocks in those industries. And then you want to always be feeding your winners, and you want to cut your losers. Paul Tudor Jones said, "Losers average losers," and I fully believe that. You want to have institutional sponsorship, because it's really from a risk management standpoint and from when you are scaling. If you're in a stock that doesn't have institutional backing, they're not going to be there to support the stock from getting hammered. And so you kind of need that from a risk management point of view. And then the general market, 75% or so of stocks are correlated to the direction of the market. So you need to really understand, where the market's heading. And, from an idea generation standpoint, For me, it really comes down to just understanding the current state of play. What is happening in the world? Where are we today? Because, I don't think that anybody can forecast the future. Super Forecasters by Philip Tetlock really lays it out where it's, our forecasting is really just as good as the experts aren't even as good as a crowd, right? So I really believe in that. So what I do is I try to understand, what is the current state of play? And then I will try to think about how can that evolve in the future and with different outcomes associated with certain probabilities. So I think about more of a probabilistic, weighted framework towards where things can go. My ideal holding period really depends on the thesis itself. So how long it would take for critical factors to play out. Something like Unity software is a much longer term kind of play for me in terms of what I was thinking. And then Fastly was shorter term. So it kind of really depends. And when you think about just the nature of technology itself, usually the leaders in certain bull markets, they are not the leaders in the next bull market. So that only really gives you about 12 to 18 months or so to really ride a name. I'm not swing trading. I'm not trying to get in and out, but I am very cognizant of just the business cycle and how stocks perform. And then, I mentioned I have certain qualitative criteria in a checklist that I use and I go by. And, not every stock is going to check every box because there's no such thing as a perfect stock. But I use it as kind of a measurement tool to see, where is this stock relative to other names that I've looked at. And it just helps me stay focused because I think that for me, at least, what allows me to be successful is being extremely focused, relentlessly focused on what I'm doing and the things that I'm focusing on. And then also just, not letting other stocks have an allocation of my capital that aren't the best. Because, I think every investor should realize that it's your money. You should demand the best out of your stocks. And so I only focus on really the best names that I can find.
That was a lot to unpack there. So it sounds like you took a pretty interesting journey in terms of kind of investing, starting out very fundamentally focused. I'm sure you know Excel very well. Sounds like from the work and
yeah.
And moving a little more to kind of like the public market and eventually finding your way to William O'Neill, who is a kind of a pioneer of combining fundamental with technical. And that's really kind of, I think, how I invest as well, is combining the two. And then how many positions at once do you hold?
Max like 10 to 15.
Okay.
So, and really there are a variety of reasons, right? You can think about Warren Buffett, that, his top two holdings are 50% of their portfolio. Charlie Munger always talks about it. But you can really look at the empirical data, right? Where, if you want to use variance as a risk factor, which I think is ridiculous, but it's taught, as the academic approach to risk, when risk is really actually, a permanent loss of capital. But when you think about variance in a portfolio, numerous studies have shown in this ranges, but really beyond about 15 to 18 names, you really captured 90% of the potential diversification benefits that you would have from having more names. So any more than that, you're really just tracking to the market. And the way that I manage my own money is the way that I manage a client's money, which is, I'm not here to manage just to the market. I want to be able to generate alpha. And so if I'm putting together a stock portfolio of say 30 to 50 names, I'm just going to be generating beta, and no one's paying anybody for that. You can just put your money into a passive index, no fees, and you'll do fine. But I'm here to really generate true alpha and outsized returns. And really the second, maybe it's even the more important reason why I only manage 10 to 15 names is because coming from the private equity background, we knew only every name in our own portfolio. We had about 50 or so some odd names, but every single company we looked at, we knew inside and out, every nook and cranny, everything we possibly could, because we felt that as owners, it was our responsibility. And you couldn't be an investor without, doing so. And because, investing in a stock, you're a part owner, you have shares in that company. So my thought process is that if I have more than 10 to 15 names, I can't really track them. I can't know everything about them. So that's another reason why. I think that you have to know your names, you have to know your companies as an owner. And if you really want to generate true alpha, you need to be concentrated. Yeah,
it's kind of interesting that like the traditional things that are taught in finance, when you start thinking about it and start applying first principles to them, you're like, wait, why is that the case?
It makes no sense.
If your portfolio is going down 1% a day for 30 days, you're going to have you're going to have very low volatility.
Right.
And so
nice and steady.
Nice and steady. And so you could go to your risk manager and say like, look, we don't have any volatility.
Right.
I'm doing a great job.
It's that, and then is volatility to the upside as tough as volatility downside? No, I don't mind if my stocks move 15% up in a day, but 15% down in a day, that's miserable, right? And it kind of goes back to prospect theory where everything is relative, right? Your losses hurt, twice as more, 3 times as more as your gains. So the whole concept of variance and standard deviation in terms of a risk factor doesn't make sense. It's for the academics just to be able to put together a model.
Got it. Cool. Makes total sense. And then on Twitter, do you find new ideas on Twitter? Do you find how are you using Twitter besides, broadcasting your ideas, getting feedback, stuff like that?
Yeah, I do love getting feedback about my own ideas and, where my thought processes can go wrong, because a big part of my own process is trying to poke holes in my thesis, right? If I don't understand the other side of the trade as well as a person who is on the other side of the trade, then I'm at a disadvantage. It's very much a Sun Tzu type of philosophy where you have to know your enemy. So I find Twitter and other mediums very helpful in helping me poke holes in those arguments. In terms of finding ideas, I don't use Twitter. I try not to, at least. Maybe I'll see something that, oh, that's interesting. But I try to really go through my own thought process and my own thought experiment to identify themes or companies that I think could be interesting. And then I'll kind of run it through the gamut of my process. Where Twitter is useful is if I do find a company, there are some really smart people out there that post thoughts about these companies. And so I can, kind of generate some ideas that way in terms of, oh, like, how is this person thinking about it? Does this make sense? But at the end of the day, I think that any investor that really wants to add value and truly understand, have conviction in their names, you have to do the work yourself. And for me, that always starts from just, once again, first principles, Occam's razor. What is the one or two things that really drive the name? And that's it. The hardest thing for me, at least, and I think a lot of people, it's hard to admit this, but the tough thing for me is I don't know everything, and I'm far from it. And so, I'm going up against these big hedge funds with all these resources, alternative data, these amazing algorithms that can just generate any sort of insight that they need. And I'm just a single guy just trying to Google search certain things, right? I'm digging through filings. So the hard thing is that not only am I new to the business where I'm really trying to learn about all these stocks and industries at once, but I don't have the resources to really learn and understand everything about them. So, what I try to do is just always inform people, like, listen, you have to do your own research because it's the only way you can truly have conviction in a name. But then also just relentlessly keep learning, and that's why I love the public markets, is because what drives me every day is just this need to learn. I'm just thirsty for knowledge all the time. So, with that framework, it never stops me from going after a company and trying to invest in it. But I do know full well I'm at a disadvantage, at least right off the bat, in terms of having a certain domain knowledge.
Yeah. Well, maybe your trading partner that you have there with you helps you research some of the ideas.
Yeah. So this is Nova. Nova, she's a big licker, so she'll try to lick me right now. But she's definitely been very helpful, very supportive of every investment I make.
That's awesome. She's super cute. All right, so that's a great segue. So let's pull up Koyfin and get into some of the ideas.
Yeah, like I told you over email, I love the new layout. It looks just phenomenal.
Thank you. We've had a lot of positive responses, some negative responses, but yeah, whenever you change anything, people change. So let me make this.
Right.
Let me make this 100%. Always a little easier to see. So tell us kind of like about the first thing and maybe how you found out about it, since you have like an interesting process. What's the first thing you want to talk about?
Sure. Let's talk about CrowdStrike. I think it's pretty pertinent, especially since they reported last night. So yeah, let's start with how I found it. I started managing my portfolio in July of this year, really at the very start of Q3. And before that, what I was doing is doing research into certain companies that I wanted to, take its place in my first, in kind of like the first allocation of capital. And so for CrowdStrike, this was a name, or an industry rather, that I've been aware of for quite some time. Cybersecurity is very pertinent. It's in the news all the time. CrowdStrike actually got or became popular back in 2016 or 17 when they were helping with the whole Russian hack investigation, right? So I was very aware of the industry itself. And so if we want to think in first principles again, right, you have a proliferation of data, we call it the data transformation. So 90% of all data ever created has happened in the past 2 years. Mm-hmm. And so data creation is going to be really exponential from here. And then you also have proliferation in endpoints, or, a mobile phone, a laptop, a desktop, especially with now the work from home paradigm or work from anywhere paradigm, that's only going to increase. So cybersecurity is something that is highly useful, and it's needed by every company, every person, because there will always be bad actors out there no matter what. So understanding that, and understanding that there needs to be a player that can protect our endpoints from anywhere that we go, the research led me directly to CrowdStrike. It did not take long for me to realize that they were the really preeminent player in the space. And why is that, right? And so my thesis for CrowdStrike also plays into, like I mentioned, the artificial intelligence research I've been doing lately. So the really heart and soul, and I guess you look at the brains of CrowdStrike, is what they call their threat graph. So their threat graph is essentially where they ingest all of the data from all the different endpoints that they protect. And in that data, like, they feed it into their algorithm. And that algorithm is then what they use to prevent, detect, and respond to attacks. And so the whole nature of artificial intelligence is that the quality of the algorithm is directly related to the quantity of training data that's fed into the program. So what does that mean? It means that there's an inherent moat to the first mover of any industry, of any company in an industry that is using artificial intelligence. So CrowdStrike is that leader. Now, it's interesting where I think about, the quantity of data for CrowdStrike. Back when I first started learning about them, they were processing 1 trillion events per week. Last quarter, they reported they were processing 3 trillion signals per week. And as of yesterday, they announced that they're processing 4 trillion events per week. So not only are they ingesting and processing more data than their competitors, but that's accelerating, mostly because of their customer growth. But then you think about it, you tie it into the product itself. Well, they're feeding more data into their algorithm than anyone else can. So they're going to have a better algorithm. So customers are going to want the CrowdStrike product rather than anyone else. So you have here a virtuous feedback loop or a flywheel where you have a better artificial intelligence algorithm that creates a better product that can protect customers better, which makes more customers want to come onto the platform, which provides more data, which makes the algorithm even better. So it's this virtuous cycle over and over again that is really allowing CrowdStrike to execute and be the leader in the space. And you see it through, like I said, their execution. And there are many tailwinds, I think, that are driving their success, with 5G, the rollout of IoT, then you have, edge computing. All of these things really just make the CrowdStrike product more important and more valuable to customers. And then you have the notion of their TAM, which is expanding. They say that their TAM for 2021 is going to be about 32 billion on the call last night. And if I recall correctly, it was about 24, 25 billion when they IPO'd in 2019. So, their TAM is also growing and expanding. And a part of that is their introduction of new products, and new modules. But you just see all these tailwinds are the back of CrowdStrike. Couple that with the fact that they are the leader in the space with the best algorithm, the best AI algorithm. And you really see that they're executing and they're getting customers faster than anyone else. And so it's almost, a no-brainer for me. And I've been long, I think, since the 90s or so, wherever it was back in June, and I've just held it throughout. And, they had a great quarter, but I'm not really in it for the quarter-to-quarter game. I don't play the quarterly earnings game that Wall Street, unfortunately, kind of pushes on companies. I think this is a very, very long-term play, and CrowdStrike will continue to outperform. Should I go into what CrowdStrike does in case anyone's not too familiar?
Yeah, absolutely. I pulled up the description here, which kind of gives us this little overview. And you mentioned the security endpoints, but maybe anything else that is relevant to kind of like the trade and how you thought about it.
Yeah, so now they're also protecting cloud workloads. And so what's amazing about that, let's start with the fact that 20% of all the endpoints that they protect are on the cloud. So there's really a lot of growth there still to be had. And then you think about cloud proliferation and penetration in general. The last report that I saw by Morgan Stanley said that right now only 20 or 25% of apps are on the cloud, and that's supposed to be about 50% by 2023. So once again, you have just a natural tailwind for them. So they're protecting not only the endpoints and cloud workloads, right? And so what's great about their product is that it's cloud-based, it's cloud-native. They weren't like a McAfee or Symantec where it was a legacy product that was all based at the company's facility itself. It was on-prem, and then they had to then pivot to cloud. CrowdStrike was built for the cloud, and so all that requires is that you install this lightweight agent on your phone or your endpoint, and you're up and running, right away. And so this frictionless, seamless go-to-market strategy, which I can dig into more, is really kind of at the back of why they're able to execute and be so successful. If we think about their pricing model, it's modular based, which is I think perfect for them. And the reason why is because so when I started analyzing CrowdStrike back in June, they had 11 modules, and I think that they had 11 modules when they went public. Today, as of through Q3, they have 16 modules. So they have more modules, which are just different products, for their different offerings, whether it be protection, prevention, or response. And so what they're doing is they're building out a more holistic offering for their customers. And the more modules, which George Kurtz, the CEO on the call yesterday, mentioned that they are consistently getting more and more demand from customers for more modules. So it's helping, right? So by having a module-based pricing model and by increasing the number of modules that they can offer, they have a structural benefit in terms of their revenue model, right? So, and then on top of it, you see that they are correct in their thesis that the customers want more modules because quarter after quarter after quarter, the number of customers that are utilizing 6+, 5+, 4+ modules keep accelerating. I think as of Q3, for the first time they report, at least that I could see, the number of customers that were using 6+ modules was at 22%. The number using 5+ was, I might get the number wrong, but it was in like the 40% range. And the number using 4+ modules was 61%. So 61% of their customers are using 4+ modules. And what's amazing about that, when you understand their unit economics, is that the cost of providing a service to a customer is covered after the first module. So every module after that is purely accretive to the bottom line. And then you crosswalk that to their financial results and their gross margins, and you see that a year ago, their gross margins were 72%, and this past quarter in Q3, it was 76%. And so you see the operating leverage at the gross margin level, and then you dive deeper into the actual operating expenses. And I'm going to be just general here in terms of where their operating expense margins were, but operating expenses were about 80 or 85% of revenue in Q3 of last year, in Q3 of their fiscal year 2020, which is calendar year 2019. This year, it was only between, I think like 60% or 50 something percent. So they have inherent operating leverage as they scale, which is something that I look for in terms of qualitative factor or even a fundamental factor for my company. So I'm just, everything that I look at for this company, it makes me extremely bullish, and I keep trying to check myself and see where I might be going wrong. But They keep rolling out more modules, providing better benefits for their companies. They just closed on the acquisition of a company called Preempt Security in Q3, which gives them access, and they are now able to provide a zero trust offering to customers, which is, if you follow the cybersecurity space, it is one of the most important parts of a cybersecurity offering, which is essentially the computer, the system, does not trust anyone from either inside or outside the organization, period. Like, it just doesn't trust you. You have to verify your identity at all times. And so with that offering now, a couple of back, they just rolled out 3 more products. One of them, Falcon Horizon, which is really for managing your cloud security posture, or the actual architecture of your security offering. They have Falcon X Recon, I believe it was the name that they just rolled out, which is people be more situationally aware of dark web threats. And then also Falcon Forensics, which is just a better automated analysis for incident response. So there are all these additional mediums that they can go after, and all these additional products that they can offer their customers, which continues to grow, which expands their TAM, which expands the number of modules their customers will adopt, and just means more revenue for them because it's a modular-based model. So, I think there are really a ton of tailwinds rather, that just makes me extremely bullish for the company, just not in the short term, but also the extremely long term.
Got it. That sounds like a great business with the incremental margin capacity that they have, by just kind of like spending all the cost is getting the first module or the first customer relationship, and then having add-ons on that. So you talked about in your process understanding the bear case, or the flip side. What is the bear case here?
Glad you asked, but I'm trying to figure it out still. Microsoft is active in the cybersecurity market, but they don't provide as many modules as CrowdStrike. So, you could say that CrowdStrike faces competition in the space from really Microsoft. And then, just sticking on Microsoft, it's hard for them to really compete because they don't have all the same offerings that CrowdStrike does. And on top of it all, they have so many different business lines. It's hard for them to focus on just cybersecurity, where that's what CrowdStrike does. They have other competitors in the space. A private company that I've been looking at, SentinelOne, they do a pretty good job. But in terms of interoperability, they struggle based off of my research. This Symantec, Broadcom's basically stopped really supporting Symantec, which is interesting, right? Because CrowdStrike's just eating their lunch. So I don't really see a lot of competition. I was trying to think about, could server costs really, eat into their margins? And I think that would be just marginal at best. Servers are able to really scale pretty easily, especially these days with serverless computing. So this one's been hard for me. I really haven't been able to find a good bear case for it. So if someone has it, please reach out.
Got it. Please reach out on Twitter. Good stuff. What's the next company that you wanted to talk about?
Let's do Unity Software. Unity is a fun one for people these days.
Okay, tell us about this one. So I've seen it mentioned before. As kind of like recently IPO'd. I've seen it on Twitterverse. What's the story here?
So let's once again just take a step back and go to first principles, right? And so I mentioned artificial intelligence as one theme that I've been focusing on, and how CrowdStrike really fits into that theme, even though it's a cybersecurity company. Another theme I've been focusing on is gaming. I think that gaming is very underappreciated and under the radar, although it is starting to pick up popularity, I think, in the investing space. But let's take a big step back and think about gaming as a whole, right? So gaming has really been able to evolve because of a lot of digital transformation and a lot of technological advancements over the years. So the internet, people may not realize, is still pretty young. It's relatively nascent. So only about 51% of the world's population are currently internet users. So what is believed by the World Bank, and I think it was Cybersecurity Magazine where I saw this as well, by 2030, it's expected that 90% of the world's population is going to be on the internet. So that's an addition of about 3.5 billion people, all coming onto the internet. And then you think about the amount of time that people spend on the internet, that is also increasing. So engagement as a whole on the internet is constantly growing. And if you break it apart between mobile and desktop, mobile is eating into desktop share of attention because we're all on the move. We're all going everywhere. We have these mini computers in our pockets that can do anything. So mobile is really starting to take over. And then you dive deeper into, well, where is the growth really going to come from for gaming? Developed markets, it's pretty available everywhere. But if you look at the cross-section between developed markets and emerging markets in terms of the digital transformation, emerging markets have surpassed the developed markets in terms of how much data is being produced by users there. So you have all of these different things coming together with the internet growing and accessing more people, the emerging markets becoming a bigger and bigger part of the digital transformation. And then you think about the actual engagement levels of people, right? So let's think about media and the transformation of media over the past, let's say, 100 years. We went from print to radio, right? And when we went from print to radio, it was a slow adoption. And think about monetization, it lagged, even though there was more engagement for radio, it lagged the monetization for print by about 10, 20 years, let's call it, right? Mm-hmm. And the same thing happened when we went from radio to TV. there was a lag in monetization, even though people were much more engaged with TV than radio. Then you go from TV to the internet and the same dynamic, right? And now you have the growth of gaming. And you have the same phenomenon where you have a lag in monetization, even though if you look at engagement levels by men and women, actually both, you have about 2.3, there's about 2.3 hours spent on gaming for young men back in 2015. And that grew to 4 hours in just 2 years in 2017. And then for even women too, women weren't even spending an hour of gaming. And then that was at 1.4 hours per day in 2017. So you have both parts of the population that are becoming gamers, right? And then you have the dynamic of games no longer are just cyclical. It's not, one hit and done, but you have legacy games now accounting for larger and larger portions of the total revenue pie. So once you create a game, if it's a winner, it's going to probably stay a winner. And there's just a wide dispersion between the winners and the losers. So it's pretty easy to identify. And all of these dynamics and components boil down to, well, where in the gaming space do I want to be? Do I want to try to pick the winners themselves, the gaming studios, or do I want to have broader access to them and kind of have a pick of the litter, if you will? And so that led me to Unity. And so I was digging into Unity, and I saw that they are behind, or they are the engine for 50% or so of the top 1,000 mobile games. They are responsible for about 60% of the total AR and VR applications out there. And so I was excited by the fact that they were really dominant in the gaming space. But then I found out that by digging deeper, that they really weren't monetizing that well. And part of it is because they have this freemium model where if your entity isn't generating up to $100,000 of revenue, then it's a free service for you. And they price on a per seat basis. So they're somewhat limited there in terms of the scale on the create side. So just taking a quick step back, they have create solutions, which is their engine, and then operate solutions, which is really how they're able to grow the revenue pie along with the developers who produce these games. So taking all these things into account, I was seeing that gaming really wasn't their big growth engine. They were somewhat tapped and saturated in terms of how much of the market they could really capture. And I think that there is a lot of room for them to monetize further for gaming, which is really the only tailwind they have there. But when I was digging deeper into the product itself and trying to understand what are its capabilities, they talk about industries outside of gaming, whether it be architecture, engineering, automotive. That is really where the intermediate term value can be had. The issue is that they really haven't had a lot of growth there since they started focusing on it the past couple of years. There's been a really slow lag in terms of actual adoption of the product in the market space, even though, when you look at different examples, they talked about on their Q3 call, Toyota was able to save, I think it was, like a 400% time save in terms of their development of their cars or whatever the product was that they were working on. So my thesis was, at least for the intermediate term, that their dominance in AR and VR is really going to be their medium-term growth engine, whereby they can shorten and cheapen the time to market for companies to bring products live. So instead of, a Toyota trying to draw out and manually tag, hundreds of thousands of parts of a car, which takes hours and days and a huge workforce to be able to do, instead, they can use Unity's engine to build the car in 3D space and tag each thing virtually so that, the specifications, the cost, all of that is embedded within the model itself. And it saves them time and it saves them a lot of money. So you're going to have this, you're going to have the dynamic that Unity removes friction from the entire process, and they should be the ones that capture the value of that friction. So that was my kind of immediate eureka moment that, oh, wow, this engine has legs, and not just in gaming, which is what everyone else thinks about. And this was what I thought is my differentiated perspective of the space. Then I connected a few more dots, and I'll try to be quick here. Live video shopping, and this is something we can talk about if we get to see, is very popular in Asia, right? And so what John Rodicello talked about, who's the CEO on the call, on the Q3 call, is that he envisions a world where not only is it just the developers that are using Unity's engine to develop products, but it's actually the consumers themselves that are using Unity real time to not only see, try on, whatever it may be, clothes, different things that they want to shop for, but it's going to be the consumers themselves that are really driving monetization of the product. That was really exciting for me because you see it working in Asia, right? So if AR and VR becomes the next major medium after the internet, which is something that Mark Zuckerberg believes, as was released in a letter that he wrote to the Facebook management team a couple of years ago when he wanted to acquire Unity, believing that Unity was the foundational player for AR and VR. If that's the case, then Unity is going to win a lot of that value. And the AR and VR space is supposed to grow at a 60+% CAGR over the next couple of years. So if they can execute on that business line with industries outside of gaming, there's a huge value to be had there. And then I want to take it one step further really quickly, and I'm not going to get too into the weeds on this topic because we could do an entire show about it, and it probably shouldn't even be me that you're talking to about this topic, is the metaverse. So John Michello believes the metaverse is here. I somewhat disagree. Tim Sweeney at Epic Games, which is Unreal Engine, which is Epic Games' engine, is the main competitor to Unity. Tim Sweeney believes that the metaverse is coming, but not here yet. And then Matt Ball is really the go-to resource on anything metaverse. So I'll forward anyone that wants to learn more either to my newsletter or to Matt Ball's website. But what is essentially the thesis here, which is very long-term, I mean, we're talking 10 plus years down the road, is that Unity can become one of the most, if not the most important technology company in the world if they become the foundational player of the metaverse, like some believe. And I can see the path there. Now, in terms of probabilities, like I talked about, like probabilistic outcomes, I think it's, I would assign it more of like a 15 to 10% probability, because there's not going to be one single founder of the metaverse. But in terms of the technology that they're developing and their focus on enabling all users to be able to develop code and use their platform, what you call a no-code paradigm, then the path is there. And the fact that they are the leaders in mobile when Unreal Engine is really the leader in the more high-end 3D development for interactive, real-time 3D content, which is really what these engines are designed for, then you really see this path where, I think in the short term in gaming, they have some tailwinds that they can use to grow. In the medium term, they can execute on their AR and VR business verticals. And then in the longer term, if they can get, if the metaverse does materialize as something it could, then Unity might be, a $1 trillion company, really one of the most important technology companies in the world.
Awesome. So you were mentioning the internet's going to be big. If the metaverse is going to be big, then this is the place to do it. Cool.
Exactly.
What's the next one?
Let's go with C Limited. And the thesis for C, and I can take a second for you to pull it up, but the thesis for C is very simple. And I think I really captured my thesis in the title of my thread for Twitter when I did C, which is, a monster is born in Southeast Asia. This company is an absolute monster. So let's first talk about the thesis, right? Well, first maybe, what is C Limited? They're essentially a platform that has 3 different business verticals. One is digital entertainment, which is called Garena, which is actually what the company was founded to do. They have a e-commerce platform that is called Shopee, and they have a digital financial services platform called C Money. So they have 3 different business verticals, but what that is it creates flywheel effects. So you have developers, and you have the relationships with the developers that leads to developers creating more games, which brings more users onto their platform to be able to use the games, which then brings more developers onto the platform to be able to access the users, right? So you have these improved monetization benefits for both developers and Garena as a result here. And then similarly for Shopee, the better tools and services for merchants that C develops, the more sellers will come onto the platform, which will attract more buyers to find the products they need, who will then benefit from the artificial intelligence algorithms like we've talked about that C uses, and the engagement tools that they've developed to really make a better and more efficient buying experience. Then the more people will buy, which will bring more sellers, and the cycle just repeats, right? And so this flywheel effect that you have for the business lines, really bringing more users on the platform through the digital entertainment Garena and their e-commerce Shopee platforms, it just creates this virtuous cycle. And then how does C Money, the digital financial services and e-wallet fit into there? Well, it's integrating C Money into Garena and Shopee to create a better user experience that really allow them to build C Money organically. So right now, what's happening is that you have Garena producing, I think it was about $530 million of EBITDA in the last quarter. And that is funding both the build out of Shopee and C Money. And when I realized this, for me, this was a huge positive. I got pushback on my thesis because people were saying, oh, this is a loser company that's losing money, they're burning cash on these other verticals. That's a problem. But if you are a student of history, which I try to be, and I still have a lot to learn, like I mentioned, but you'll realize that Amazon did the same exact thing. Right. Amazon plowed in really all, and Chamath talked about this on a podcast I was listening to him do, and he did a brilliant presentation on this, where every revenue line item or every expense line item in Amazon turned into a revenue line item for them. So that is essentially what C Limited is doing here, right? So they are adopting the Amazon model essentially, which I believe it's working actually very well, and you can see the execution of the numbers. And then you tie in the actual TAM that they have and the opportunity that they have. So in Southeast Asia, and this is a similar concept for Latin America and why I'm bullish on Mercado Libre, is they only have, as of the last quarter, with 6% e-commerce penetration in the region, where in the US, it's 16% plus and then growing fast, right? And so you have a huge runway in terms of e-commerce growth. And you have the fact that Southeast Asia, their internet economy is expected to reach 6.3% of the total internet economy in the world by 2025. There are just natural tailwinds here for this company. And, when you look at monetization, like I talked about with Unity, there are opportunities for C when it comes to Shopee, but they're not using it yet because I think they're being smart and they're just trying to really win the market, which right now when the market's growing, now is its time. And Forrest Lee, who is the CEO, I think brilliantly recognizes that. And he is making the smart decision by sacrificing, free cash flow in the intermediate term and the short term to build the biggest monster that he possibly can for the long term.
It sounds like a pretty audacious bet, and reminds me of, like you said, Amazon, but also like Tencent.
Yeah. Exactly.
And I'm just looking at the revenue, like they're a $100 billion market cap company. So talk about valuation in a sec, but growing revenue at over 100% with a pretty big base of $3 billion. So that's pretty monster.
And so, right, I think that their fundamentals and their revenue results. I talk about execution, and this is a prime example, right? Digital entertainment. If we bifurcate or break apart rather their business lines and how their revenue is growing, digital entertainment, it grew at I think 75%, which which grew up to, I think it was off a base of like 600 million. So like right there alone for the quarter, that's a massive bump up to almost $1 billion. And then you have e-commerce, which grew, I think it was 165% year over year, which is just staggering. And then their digital financial services, I think it was an increase of, it was like 800%. And now once again, they were working off a base of like $2 million. It was tiny a year ago. But, like I talked about, the fact that you can integrate C-Money with Garena and Shopee, which are both growing extremely fast, you have multiple tailwinds. And it's so, when you look at the chart, right, of revenue, it's simply staggering what they're able to do. And they are actually EBITDA positive. If I'm thinking about it, I think adjusted EBITDA was about $120 million for the quarter. And I mentioned, Garena generated 530 plus million. And it just shows, they're actually funding the shortfalls in e-commerce and digital financial services. And it would build out, just a beast. And so, when you look at the fact that they are able to successfully plow back in those earnings, operating earnings, let's call it EBITDA, into these other verticals, and it does result in follow-on massive growth, then that gives you confidence in the management team that they know how to execute. And then I'm going to forget all of the actual revisions that they made to their full year and Q4 guidance, but they were increasing their guidance last quarter by like 30% over and above their prior guidance, which is just remarkable. And it shows you how there was a true pull forward in not only, from everyone being from home and playing more games for Garena, but also e-commerce. So everything to me just points to a company that is an absolute monster that is growing rapidly in the region. They are actually backed by Tencent. I think Tencent now has about a 20 or 25% stake, which started off as 40%. So, C is one of just these monster companies that I think has potential to actually 10x from here. They're at $100 billion, like you mentioned, which is based off of the quarter they did $1 billion. Let's say that they're going to do, let's say, $4 billion annualized at 25 times sales. It's definitely aggressive, but when you break apart their opportunities, and something I talk about is real options pricing. When you think about their opportunities versus what is currently priced in, I think that over the long term, this company is they have a similar opportunity like Shopify to really just take over a market and dominate. And just I'll mention really quickly, thinking about risks in all of my different investment theses. One of the big risks that I saw from Mercado Libre was actually C Limited. Last quarter, they started really getting involved in Brazil, which is the biggest market in Latin America, C Limited did. And when you look at Google Trends of search results for different e-commerce companies in Brazil, C Limited is up and to the right. There is massive growth there. And Forrest Lee talks about, it's a big initiative for them. So if they're able to dig into and penetrate Brazil, then it'd be interesting to see what they can do in other, emerging markets aside from Southeast Asia and, specifically Indonesia, which is their biggest market.
So let me pull up CrowdStrike, and then I'm just going to do EV to sales. And then I'm going to add C here. And then I'm going to add Unity. And then I'm just going to make these all on okay, I'm going to make all on the same axis. So you have C here, which is the cheap one here at 13.5 times sales, and Unity and Crowd at really kind of like do these multiples scare you at all? Well, I guess this is the bear case.
Yeah, right. So let me talk about multiples kind of at a high level. So what you're seeing historically is that the best performers you actually have to pay up for, because you would think about a multiple in two different ways. One is if it's high, let's talk about high multiples, it's expensive. The other perspective is that it's a high quality stock and that's recognized by the market. So in the past, these companies are the ones that have actually outperformed. And then you look at, and so you see the multiple here for CrowdStrike, how it just, is that CrowdStrike? Yeah, how it kind of just plummeted. Well, what's happening is that CrowdStrike is growing into its multiple, right? And you see it with a lot of these high growth, let's talk about SaaS companies. You're seeing that they're generating for CrowdStrike 87% year over year growth. So when that's the case, and the sell side is thinking about 40%, I think it was, that I saw estimates at one point, they're going to grow into the multiple over time. So the multiple itself doesn't scare me. What I focus on is, and this goes into time horizons too. When you break apart investment returns, if you are in a stock for a long period of time, what truly matters for value is the actual compounding of earnings or free cash flow, whatever is being returned to the shareholder. That has a much higher impact over time than the multiple paid. Now, of course, returns are a result of the price you pay, but over long periods of time, that's not the case it is the case, but it's not the driver. The driver is truly fundamental growth. Now, the pushback additionally could be, well, what company can maintain growth of 30+%, 40+% for years on end? On a base rate basis, very few companies do. Yep. But if you look at the king of SaaS, right? The original, the OG, if you will, Salesforce, they're still growing 30% top line, year over year. Right. And so I think that there's just the potential for these companies to grow into their multiples. Now, I would caution, and this is what I try to do for every high growth company that you are valuing, you should always think about multiple compression, because, in a couple of years, I don't think that this, 30 times sales, 40 times sales is sustainable. So I do think that you need to factor in multiple compression, but at the same time, the company will grow into their multiples enough where it won't matter as much. Now, when we compare both CrowdStrike and Unity to C Limited, the reason why C is going to have a lower multiple when you look at sales is because you're not going to value each business unit, if you're doing a sum of the parts, as the same way that you would for a software as a service company, right? So for Shopee, for instance, you're going to use probably a gross merchandise value multiple of, say, 1 to 1.25 times, which is what I did. Garena and the gaming unit, you can apply more of a sales multiple to, but that's why you're going to have a lower multiple for C Limited. And then let's talk about Unity, for instance. Now, Unity is interesting to me because I actually am not very bullish in the intermediate and the short term at these levels. I think that it's actually overextended. What a lot of people may not realize if they haven't done the research is that Unity is they're not a software as a service company. They don't have a lot of recurring revenue. It's only 35, I think, % of their total revenue base, maybe 30% of their revenue base is from Create Solutions, which is their gaming engine. 60+% is from their operating solutions, which is more on a revenue share type of basis. So and then digging in deeper, 30+% is from advertising. And when you look at, fintech advertising companies and how they're valued in the market, they actually demand a lower multiple than, a regular software as a service company. But what Unity did, it seems like to me, is when they issued their S1, they kind of underplayed that dynamic and made it look like they were more of a SaaS type company. So that's why I think the market right now is valuing Unity at a really high multiple. And that should come down, at least from my perspective. I'm not long Unity right now. I think that is overextended. And then I think one more thing as it relates to Unity, and this is just a gut feel type thing to me, but something really kind of weird has been going on in the market where you've had a lot of these new issues just going absolutely vertical. And, that could be the result of there was a lot of cash sitting on the sidelines. But when you look at, a Palantir, a Unity, a Corsair Gaming, these companies, and then, Jumia Technologies is not a new issue, but, you are seeing these just spikes, these vertical moves of these companies. So that's also got me a little bit hesitant about putting capital behind companies like that have moved like that right now. And it also goes back, like we talked about, the William O'Neill framework. I buy common stock when stocks are breaking out of a base. And right now, Unity is overextended. So that's not a name that I would start a new position in. CrowdStrike actually is in a buy zone. They are in a pivot area. So that is actually a company that if a listener wanted to go buy CrowdStrike right now is a good time to do so.
Cool. So on a technical basis, this kind of sets up the best out of all of them.
Yes. Yeah. CrowdStrike right now to me. So, you'll be able to look at it, right? I think that, the high of, you're going to see somewhat of a cup right there, right? On the right-hand side, there's going to be a cup. And the high there was about 153 or 153.9, I believe it was. And so what you're going to want to do is a pivot area, you can add to a stock or, start a position within 5% of the pivot, which is the top of that base. And so 5% of 153 is going to be 166 or so. So, now is actually a reasonable time, if you follow the cancel methodology, to either start a position or add to the name. Me personally, I own the name, but I added to it today. I added the strength and I'm perfectly fine with that because once again, it's a long-term play for me, but it's also a high probability setup. If you look at other bases, you can see that this dynamic has happened in the past. It wasn't a cup, but right before then, there was another base that was formed. It's a double bottom. Right there in the July time period, there was that double bottom that formed. And then you saw as soon as it broke that right-hand side there, it just accelerated right up to form the the left-hand side of this current base here.
Right.
Yeah, so I mean, that's beautiful stuff to me, and technicals, if I'm to break it out between, in my investment process, what is the percentage of fundamental analysis versus technical? I would say fundamentals 80 to 85%. The technical is about the 15 to 20%. And I say to people, fundamentals tell me what stock to buy, technicals tell me when to buy. And I follow a rules-based process because I want to take as much emotion and subjectivity out of the equation as possible. Because investing is an emotional process. Until you're in it, until you're managing other people's money, until you're managing your own money, it's really hard to envision. But it is emotional. But by using rules-based processes for both buying and selling, you can remove a lot of that emotion, which can make you more successful, I believe, in the long run.
Cool. And over the next 5 years, if you had to pick one of these stocks, which one would it be?
It's between C and CrowdStrike. It'll probably be C. I think C has a bigger tailwind behind it, but that's a tough one.
Monster Asia. Okay.
C
good.
is a monster. Yep.
Got it. Okay. Awesome. So want to finish this off with two things. How can people follow you and your work?
Sure. So the best place to follow me is on Twitter. It's at Seifel Capital, which I know you'll include in the notes. And I have a Substack. It's seifelcapital.substack.com. But what I did actually for this last newsletter I did was I actually created a website for myself. So people can also go to seifelcapital.com. And that's where I'll be moving over all of my newsletters, a lot of my work. I'll have a lot of my Twitter threads on there. That's a good place to follow me. But, one thing that for anybody that does want to reach out, I've taken a very non-traditional path to the public markets, but it's what I love to do. So I'm just going to keep grinding away until I get there. I've had certain people help me out along the way, and it's made a huge difference in my life. So if anyone's listening and you do want to reach out, please do so. I respond to everybody. I am more than happy to chat, talk about, your process, your journey, how you can get to your goals, because it's been very helpful for me. So please feel free to reach out.
Oh, that's really generous. And then last thing, wrapping up, if you want to recommend one TV show or movie that you've watched over the past couple months or year, as everyone's still in this home stretch of the lockdown, what would it be?
Sure. So it's interesting. I'm actually rewatching it right now, and I've lost track of how many times I've watched it, but it's Band of Brothers on HBO, and you can get it through Amazon Prime, I think. Band of Brothers to me is the best series that I've ever watched. I think I've watched it about 6 or 7 times. And it's, I only watch TV before I go to bed, I'm in bed kind of being lazy. But, Band of Brothers is something that is just so well done. It's Steven Spielberg and Tom Hanks, and they just put on a masterpiece. They have another version called the Pacific, which is about the war over in Japan. But for me, Band of Brothers is far and away the best. But, what I've started doing is actually reading a lot more. And so there are a lot of books that I could actually recommend. So I'll use this to also recommend a book. And I think the one book that's really played the biggest, let me do two. The one that's played the biggest impact on my life is Thinking Fast and Slow by Daniel Kahneman. I think that understanding human behavior and your own cognitive biases is extremely important, not only to investing, but to life in general. And then a book that I'm currently reading is called Finite and Infinite Games, which, some people disagree with me, but I believe that investing is an infinite game. The goal is to continue the game, and, anyone can play. And so I think that, those two books have really had a profound impact on my life.
Cool. Awesome. Got some bonus book suggestions in there as well.
That's right.
Cool. Well, Chris, this has been an absolute pleasure. Learned a lot about these stocks and kind of different way of thinking about investing. Glad to have you on, and make sure to follow you on Twitter and talk to you soon.
Thanks, Rob. Thanks so much. This was great.